Since 2019, the essentials of American life, rent, groceries, and cars, have soared faster than most paychecks. A typical family now spends nearly every dollar just to keep the lights on. But by 2026, millions more could face a reality where saving is a luxury and deprivation becomes the norm. How did we reach this breaking point? Mortgage rates have more than doubled since 2021, climbing from historic lows near 3% to well above 6% for a typical 30-year fixed loan. This sudden jump, combined with years of underbuilding, has shut millions out of homeownership. With fewer buyers able to afford the payments, would-be homeowners remain renters, driving up demand and squeezing rental supply even further. The numbers tell the story. In cities like Phoenix, Tampa, and Atlanta, rents soared by more than 20% in less than 2 years, far outpacing wage growth. Nationally, the Consumer Price Index for rent jumped at its fastest pace in decades, with double-digit increases in many Sunbelt metros. Permitting for new multifamily housing has lagged behind population growth, especially in high-demand regions, leaving vacancy rates low and competition fierce. One housing policy expert explains that we are seeing basic supply and demand at work. Too many people chasing too few homes, and those who cannot buy are forced to bid up rents. For a single mother in the Sunbelt, the consequences are immediate. Her 2-bedroom apartment, once affordable, now costs several $100s more each month. As rent claims a bigger share of her paycheck, she faces impossible choices, cutting back on groceries, skipping routine medical care, or moving to a cheaper, more crowded unit. The mechanics are clear. Higher mortgage rates lock buyers out, limited new construction keeps supply tight, and the resulting rent surge leaves millions spending over 30%, sometimes even half of their income just to keep a roof overhead. At the checkout line, the reality is impossible to ignore. Grocery bills have climbed nearly 30% since 2019, according to the Bureau of Labor Statistics. The same cart that once cost $100 now rings up closer to $130. This is not just sticker shock. It is a weekly squeeze that leaves little room for error. The drivers are everywhere in the food system. Higher fuel and fertilizer costs, supply chain snarls, avian flu outbreaks that wiped out millions of egg-laying hens, and labor shortages from fields to warehouses all pushed prices up. Even as some of those shocks faded, prices stayed high. The USDA reports that food-at-home inflation remains above historic averages, with staples like bread, milk, and eggs leading the surge. For families on tight budgets, every dollar counts. A single mother in Phoenix faces the same hard math each week. Trade down to cheaper store brands, skip fresh produce, or stretch meals with more pasta and rice. When prices for basics jump, there is less room for protein, fruit, or anything that is not strictly necessary. Nationally, food is a non-negotiable expense, but the options shrink as paychecks fall behind. The result is a quiet reshuffling in shopping carts across the country. Less meat, fewer fresh items, more processed foods. For some, it means skipping meals altogether or turning to food banks when the money runs out before the month does. The cost of eating at home has become a relentless pressure, one that is reshaping diets and deepening the risk of food insecurity for millions. Across much of the country, a car isn't just a convenience, it is a lifeline. But for millions of Americans, the cost of owning and maintaining a vehicle has soared beyond reach. Used car prices tracked by the Manheim Index jumped nearly 45% between early 2020 and 2022. Even as prices eased slightly, they remain far above pre-pandemic levels, and inventory for affordable, reliable vehicles is still thin. For many, the only cars available are older models with higher mileage, leading to more frequent and expensive repairs. The financial squeeze does not stop with the sticker price. Auto loan interest rates have climbed sharply. In 2019, a borrower with decent credit could expect a rate around 5% on a used car loan. By 2024, that same borrower faces rates closer to 9 or 10%. For those with lower credit scores, double-digit annual percentage rates, sometimes 15% or higher, are now the norm. That means a basic used car, which might have cost $250 a month to finance before the pandemic, now demands $350 or more, even before factoring in insurance. Insurance itself has become a major burden. The Consumer Price Index for auto insurance rose nearly 50% from 2019 to 2024, far outpacing overall inflation. Average annual premiums, once around $1,100, have climbed to $1,800 or more in many states. For rural and exurban workers, where public transit is scarce and distances are long, these costs are not optional. A single breakdown or a missed insurance payment can threaten not just mobility, but employment itself. In regions where a car is the only way to reach work, a sudden repair bill or repossession can quickly spiral into lost income and even deeper financial trouble. The combined weight of higher prices, steeper loan rates, and surging insurance premiums has turned car ownership, a basic requirement for many jobs, into a fragile balancing act with little room for error. After-tax wages for lower-income households have barely budged in recent years. Bank of America's latest data shows that for these families, paychecks grew by about 1% in the past year. At the same time, the cost of living, driven by housing, food, and transportation, rose closer to 3%. That difference may sound small, but it adds up fast. If expenses climb by $300 over 12 months, but wages only increase by $100, the gap has to be filled somewhere, and too often that means cutting back or taking on debt. For middle-income workers, wage growth has hovered around 2%, still trailing the pace of rising bills. Higher earners have seen better gains, with after-tax income up about 3.7%. But most families are not seeing those kinds of raises. Sector data from the Bureau of Labor Statistics shows that jobs in retail, food service, and caregiving, fields where millions of Americans work, have seen some of the weakest wage growth. The result is clear. Paychecks stretch less each month, and the gap between what families earn and what they need to spend keeps widening. Eviction filings are surging in cities like Phoenix, Atlanta, and Houston, where Eviction Lab data shows cases now outpacing 2019. In some counties, filings have doubled as tenant protections disappear. Completed evictions have surpassed pre-pandemic averages in several major cities. Legal aid offices are overwhelmed, and tenants often get only minutes to defend their homes. For many, a single missed paycheck or medical bill can mean losing everything. The pressure extends beyond housing. The USDA reports food insecurity among families with children has returned to early pandemic levels, with over 12% of U.S. households lacking enough to eat at some point last year. Food banks in expensive regions cannot keep up, sometimes forced to ration or turn people away. Utility shutoffs are climbing too. In 2022, nearly 3 million households lost electricity for non-payment, a 29% increase from the previous year. Early 2024 data indicate even more families at risk as assistance dwindles. A legal aid worker sums it up. Every week I see families choosing between rent, food, and keeping the lights on. Looking ahead to 2026, the numbers reveal a stark reality. Using household-level data and mainstream forecasts, economists run micro-simulations to estimate how many more Americans will be living paycheck to paycheck if current trends persist. Under a baseline scenario, where inflation slows but remains above the Federal Reserve's target, and wage growth for lower-income families lags behind, between 6 million and 12 million additional households could fall into paycheck to paycheck living by 2026. If inflation proves more stubborn, staying above 3% while wages fail to keep pace, the risk grows. Projections show 12 million to 20 million more households on the edge, especially in regions already facing high rent and food costs. These scenarios assume no major policy changes, just a continuation of today's pressures. But the models also show that targeted interventions, like expanded rental aid or stronger wage supports, can make a measurable difference. With robust action, the projected increase in paycheck-to-paycheck households could be cut by 30% to 50%, sparing millions from falling into financial peril. The stakes are clear. The path chosen over the next 2 years will decide whether millions more Americans are forced to live with no margin for error. Today, rising costs force millions of Americans to the financial edge, with no relief in sight. If wages keep lagging, basic security becomes a privilege, not a right. The line between stability and struggle is vanishing. What happens next will define the future for every working family. Share your perspective below.